Welcome to Investing Insights. I'm Margaret Giles, Content Development Editor for Morningstar Inc. More investors are thinking about cash as an investment thanks to higher cash yields. But those tempting yields can come with big tax bills. Can investors have their cash and keep it too? An exchange-traded fund launched in December 2022 aims to make that happen. Manager research analyst Lan Tran with Morningstar Research Services is here to explain the ins and outs of the Alpha Architect 1 to 3 month BOXX ETF, known as BOXX. Here's our conversation. Thanks for being here, Lan.
Thanks for having me.
All right, so the BOXX ETF, when it launched in December, got a lot of attention. So can you explain why it was created and what makes it stand out?
Yeah, the fund has definitely grown a lot recently, and I think the main appeal really is tax. And so the way that BOXX is set up is advantageous from a tax perspective. What it's trying to do is to give you the return of a 1 to 3 month treasury bill, what we would consider, broadly the risk-free rate or the cash yield rate, but without the interest income that treasury bill would pay out. And so if you hold treasury bill, you get the interest income when the treasury bill mature, and also, as you mentioned, the tax bill. And so that's getting taxed at the ordinary income tax rate, which is pretty high, and your tax bill can be pretty hefty. When you hold BOXX and it's not paying out anything, your tax bill only really comes when you decide to sell the funds, right? And that's getting taxed as capital gains. If you hold the fund for longer than a year, that's long-term capital gains. And so that is going to be lower than the ordinary income tax rate in for most tax bracket. And that's not an easy thing to do, otherwise more people would have done it. But it's also not a new or novel concept. So the fund used a very popular option trade called box spread, hence the ticker BOXX. And that's been around for a while. They just managed to figure out how to package it inside an ETF.
Got it. So you mentioned that box spread. Can you explain what that is and how it works in a little more detail?
For sure. And I will try to keep it as simple as possible. So bear with me here for a second. So a box spread is a combination of 4 options position with the same expiration date. What you really need to know about it is just that it behaves like a zero coupon bond when the options are all combined. And what do I mean by that? So let's consider, say, a box spread on the S&P 500 with options using the S&P 500. And so the payout for that box spread, what you get when those O4 options expire, is predetermined. It's a constant fixed amount that you will always get regardless of what happens to the S&P 500. And so that's like a coupon bond because then the price you pay for the box at the beginning determines your rate of return, right? So similar to a zero coupon bond, that's predetermined par value you get at the end. You buy at a discount at the beginning, and the difference is your rate of return. So why do we say that that rate of return is similar to the cash yield or the risk-free rate? And that's because you get, for any investment really, the return you get is compensation for the risk that you take. And here you're not taking on a whole lot of risk. You were talking about how you don't get any, you don't have really any equity risk because the payout is the same regardless of what happens to the S&P 500. You're not taking on early assignment risk, which is an issue with box spread in general, but not an issue with box the fund because the manager are using European style options. Those cannot be assigned or exercised early. You're also not taking on a whole lot of counterparty or credit risk because the box the fund is using exchange traded options are centrally clear by the Options Clearing Corp, the OCC. And so really the only thing you're getting exposure to is a sort of interest rate risk, the duration risk of the duration of the box. And in this case, it's very short. It's 1 to 3 months. And so you're getting 1 to 3 month treasury bill return.
Interesting. That certainly is complicated. So you touched on this already, but the main appeal of this fund is the tax savings. Can you talk about that again? How does this strategy deliver tax savings to investors?
Yeah, that's the important question. And again, a little bit of simplification here because the actual tax code is a bit more complicated. But there are 2 main reasons for that. The first one is that ETF, the ETF structure, is more tax efficient than the mutual fund structure. And the second reason is that the way that BOXX is set up its option in a way that let it take advantage of that ETF structure. And so why is an ETF more tax efficient than a mutual fund? It's because of this thing called an in-kind transaction. And so when you sell a mutual fund, you go to the fund manager and the fund manager sells some stocks. They get some cash, they give you your money back, but they realize capital gain after they sell the stock. And so that's not optimal, right? Because it's taxable. When you sell an ETF share, you're not trading with the manager. You're trading with an authorized participant, which are institutions that are specifically designated to handle market trade for an ETF. And so the authorized participant go to the ETF portfolio manager. They say, hey, I have some ETF share. Get me a basket of your stock that is worth the same amount that these shares. And so in reality, what they did is just swapping some shares. They hence in kind moniker. And so they actually haven't dealt in cash at all. And so that's not taxable. So the thing is, though, not everything can be in kind, right? So there are restrictions, obviously, and we will get into that. But just know that options on stock and ETF can be in kind. A little bit of history background: in 2017, the SEC allowed a fund manager to do that, and that's precedent. And we operate on a precedent basis, so that's that. But what does BOXX hold? A lot of BOXX spread on SPY, which is the SPDR S&P 500 ETF trust, which is an ETF trust. But those are in-kindable. They also can sometimes hold BOXX spread on single stock that they can use to harvest loss to offset any potential capital gain that they might get throughout the course of operating the fund. But either way, both of those options are in-kindable. And so I think if you look at the history of the fund, you might notice that they used to hold options on the S&P 500 index itself, SPX option. As the fund have scaled, they've been able to use SPY option. And so index option is a whole nother topic and different tax treatment. They had to do other things to make it work. But either way, now they use SPY options. That's our in-kindable. So.
Gotcha. I feel like we're just getting into more and more complicated. But if I understand correctly, the timing of this maybe becomes a little bit important about, when they're putting on these options. So overall, is BOXX delivering on its promises? Has it been able to keep the tax bill low and deliver the returns that it says it will?
Yeah, and so the return wise, it's been close to the 1 to 3 month Treasury bill return. Payout wise, even as I mentioned that they previously used index option, which is more complicated. Actually, since inception, they haven't paid out any taxable distribution, no dividend, no capital gain, no return on capital or anything. Since inception in December 2022, which is its own caveat because that's a short track record. It's a year and a half at this point, and so we'll still have to keep an eye on the fund, how the manager are implementing the strategy and any potential sort of operational or legal hiccup. But yeah, so far, so good.
All right. So cash yields are currently high thanks to an inverted yield curve, and BOXX has passed $3 billion, I believe, in assets since it launched. Do you think the ETF will continue to attract investors even if cash yields drop?
Yeah, I do agree that some of the appeal has been because of how high cash yield has been. But I do think that tax is always top of mind for investor, A, and B, people always do need to hold some cash, whether it's an emergency fund or if it's a short-term liquidity needs, a big purchase, or even, behaviorally, if they are trying to have a small buffer of cash for market volatility. We can talk in a different day about whether they should do that or not. But regardless of what it is, people do need cash, and I don't think the appeal will be completely gone after the Fed cut rates, whenever that might be.
Got it. So, how can investors properly take advantage of what this ETF has to offer?
Yeah. So again, the main draw is tax, right? So investor in tax deferred account or any tax deferred account that you might have is not going to benefit from this. But if you are looking to harvest, cash yield in a taxable account, you consider this alongside a traditional money market fund. I would say, we throw around the term cash today a lot, and also just in investment in general. But there are a difference between like paper monies in your bank and cash-like instrument, right? So from your deposit to a CD that's FDIC insured, or T-bills or money market fund to something like this, like BOXX, the more complex you get, the more marginal risk there are. And so obviously be aware of what you're getting into and the risk involved with that. The prospectus of the fund is long, but do read it. It's there for a reason. And so, yeah, just keep an eye on your investment as, they evolve.
So it feels like first thing is just do your due diligence,
Yes.
perhaps.
Yeah.
So do you anticipate any other ETFs following in BOXX's footsteps, or is it going to kind of remain unique in the market?
That's a million-dollar question. I would say the investment strategy itself is not complicated. It's as I mentioned, it's a popular options trade. People have been doing it for a long time. The manager are not trying to add anything fancy to it. They're not trying to find mispriced box, so they're not trying to get alpha from it. They're just trying to get the risk-free rate. So in terms of investment strategy, it's not hard to replicate. But there's always the challenge on the operational and legal side of thing, especially with something as complicated as this. Is going to be a hassle to set up, and so we'll keep an eye out on the space to see. But yeah, we will not be surprised if someone else tried to do the same thing.
Got it. So to finish up, what's a key takeaway you have about this ETF, and is it worth the hype?
So the first takeaway is that the investment strategy work, right? The concept of box spread works. It's been around for a while. It's just a way to get you the risk-free rate. That's like getting a T-bills, but without the associated interest income. The other takeaway is that from a payout from tax perspective, I mentioned so far so good. The fund has not paid out any kind of taxable gains so far. The options that it use is able to in kind within an ETF wrapper, so they're allowed to do that. But we also the caveat is that the tax code is complicated. We don't have a crystal ball into the future or what the tax authority is thinking. So we'll continue to keep an eye out on that. I wouldn't evaluate if it's worth the hype or not. I think the ETF has been getting a lot of traction, especially for a smaller issuer. But I do think it's doing what it's say that it would do. So,
All right, that's good to know. Well, Lan, thanks for taking the time to explain a lot of complicated issues and how this interesting, kind of unique ETF works.
for sure. Thanks for having me.
That wraps up this week's episode. Subscribe to Morningstar's YouTube channel to see new videos about investment ideas, market trends, and analyst insights. Thanks to senior video producer Jake Van Kersen, lead multimedia editor Ivana Hampton, and associate multimedia editor Jessica Bevel. And thank you for watching Investing Insights. I'm Margaret Giles, content development editor at Morningstar.